So now, children, again, last time I have already sent you the solution of question number 38. So still let's discuss more on that 38. Here you are asked to prepare the journal entries. So journal entries of here, first here M is retired. So the stock value is decreased. Value of furniture is also decreased. Plant and machinery is also decreased. Building is also decreased, and there is an increase in the provision for doubtful debt. So provision for doubtful debt is to be created at the rate of 850 is to be provided. So the journal entries: revaluation account debited to stock account, to furniture account, to plant and machinery account, to building account, and to provision for doubtful debt account. So revaluation account is debited, stock is credited by 2300, furniture is credited by 500, machinery, plant and machinery is credited by 750, building is 4000, and provision for doubtful debt 850. So revaluation account is debited, 8400 is debited, and stock is credited, stock is decreased, credited, furniture is decreased, credited, plant and machinery account is decreased, credited, building is decreased, credited, and PBT is to be provided 850 is also credited. So in this way, there is no increase in the asset, there is no other increase in the asset, neither decrease in the liability. That means whatever here revaluation account is debited 8400, this is a loss on revaluation, and this loss on revaluation is to be debited to the partner's capital account, all the partner's capital account, including the retiring partner. M and O capital account, partner's capital account, M capital account debit, N capital account debit, O capital account debited, to revaluation account 8400. So 8400 is the revaluation account loss. So it is to be debited to the partner's capital account M and O 3:2:1. M is debited 4200, N is debited 2800, and O is debited 1400 on the loss on revaluation. This is in the old ratio, 3:2:1 is the old ratio. So loss on revaluation is debited on the old ratio, 3:2:1. So there is a profit and loss account shown in the liability side. This means this is an undistributed loss. This loss is to be this is a profit, undistributed profit. Profit and loss account shown in the liability side of balance sheet is an undistributed profit. So before the retirement, this profit is to be undistributed profit is to be distributed among the old partners. So this is an undistributed profit and loss account. Can say this is a profit is not distributed. So 4500 you have to before the retirement of the partner. So you have to distribute this profit and loss account showing in the old balance sheet. The journal entry is profit and loss account debited 4500 to M capital account, to N capital account, to O capital account in the old ratio. So M share of profit is 2250, N is 1500, and O is 750. This is the profit shown in the balance sheet liability side, undistributed profit. This is to be distributed among the old partners before the retirement in their old ratio. And now after there is a goodwill value. The value of goodwill is shown here. 6000 is the value of goodwill. The value of goodwill is 6000. So M is the retiring partner. M's share of goodwill is 6000 into 3/6. That is 3000 is the value of share of goodwill of M. And share of goodwill of M is 3000. So what is the treatment of goodwill here? Retiring partner, continuing partner's capital account debited to retiring partner. Who is the continuing here? N and O is continuing. N capital account debited, O capital account debited to M capital account. So this is in their gaining ratio. N capital account debit, O capital account debited to M capital account. So in this is how you pass journal entry and prepare the partner's capital account. So by preparing the partner's capital account here, now after the goodwill, this is the treatment for goodwill. Continuing partner's capital account debited to outgoing retiring partners here. N capital account debit, O capital account debited to M capital account. M capital account is created. M is retiring partner. Retiring partner share of goodwill is 3000. So 2000 is N capital account debited, O capital debited 1000 only, and M capital is created by 3000. This is the treatment of goodwill. Now after preparing the partner's capital account, we found that M loan is 41,550. The M capital account is to be closed, and M capital account is closed, and the amount whatever firm has to pay to M is transferred to his loan account. The amount payable to M is transferred to his loan account. The transferring to close the M capital account debited to M loan account 41,050. So this is how we transfer the M capital account, close the M capital account by transferring his amount into his loan account. M capital account is closed now by transferring his amount 41,050 in his loan account. The journal entry is M capital account debited to M's loan account. Now next one is M. There is a part payment at the time of retirement. 11,050 is the part payment. So M loan account debited to bank account 11,050. This is a part payment to M on retirement. 11,050 is paid, and remaining amount will continue as a loan account. We will be preparing the M loan account to see how the loan account is prepared here. So this is the prepare. Now we'll prepare the M loan account. Now children, let's see this question again. So here question number 38. So now here M is to be paid 11,050 in cash on retirement, and the balance is paid in 3 equal installments. So this point is to be noted here: 3 equal installments with interest of rupees 5 at the rate of 5% per annum. So you are asked to prepare journal entries, necessary accounts, balance it of continuing partner, and the account of M till it is finally closed. So you have to prepare the account of M till it is finally closed. So here it is asked to prepare the M loan account. So first of all, on the date of retirement on 1st April 2012, by balance brought down 41,050, and M is paid to bank account 11,050 as per this year. 11,050 M paid here. So to bank account M paid 11,050. Balance of cash left is 30,000. So this balance brought down here. Balance brought on 1st April 2012. Now at the end of the year, 31st March 2013, by interest at the rate of 5%. So at the rate of 5%, interest will be 1,500. Here we have prepared at the end of the year, 31st March 2013, to bank account. So this loan 30,000 is to be paid now in 3 equal annual installment. 3 equal annual installment means each installment is 10,000. So 10,000 plus 1,500. So that means 11,500 we have to pay. So balance CD now. To balance carried down now. So 20,000 is the balance CD. So here 31,500. 31,500. So this is the first installment paid. So this is the retirement by balance brought down loan transfer here. Credit side on 1st April 2012. Balance of loan transfer here in the M loan account 41,050 is the balance of loan. On the date of retirement 1st April 2012, 11,050 is paid. So on that date here 30,000 is the balance left. This 30,000 is to be paid now here. Balance brought down, 30,000 transferred here. So this 30,000 is paid. It is to be paid in 3 equal installments. That means every at the end of year 31st April 2012 means 31st March 2013 10,000, 31st March 2014 10,000, 31st March 2015 10,000, then 13, 14, 15. In 3 years 10,000 we have to pay 30,000 into 3 equal installments. Each installment is of 10,000. But we have to pay interest also at the rate of 5% interest. So first we have to calculate interest here, credit interest here. In the 31st March 2013 by interest 5%, 30,000 into 5% interest. That means 1,500. So here you have to pay now. On 31st March 2013 we are paying to bank account 10,000 is the annual installment plus 1,500 interest. 11,500 we are paying now. So balance left is 20,000. So this will be now in the next year 1st April 2013 by balance brought down. By balance brought down how much? 20,000. This 20,000 is transferred here. So 20,000 balance brought down in the next accounting year. So now when is the last date now? 31st March 2014 by interest. First we have to make interest due at the rate of 5% on 20,000. So 20,000 into 5%. So what is the amount? 20,000 into 5% is 1,000 interest. So this we have to pay here on 31st March 2014. We are paying to bank account. How much is each installment is 10,000 plus we are paying interest also 1,000. So 11,000 we are paying. So every time when we are paying installment, each installment 10,000, we have to pay interest also. Interest also we have to pay. So interest also. So interest is 1,000, 10,000 plus 1,000, 11,000. Now on that date to balance CD. To balance carry down how much? 10,000 is the balance CD. So this is the balance CD here. Now 21,000 is the total. 21,000 is the total here. The balance CD, this one again 1st April 2014. 1st April 2014. So this will be brought here by balance brought down. This 10,000 balancing balance brought forward is 10,000. So this 10,000 we have to pay at the end of the year. First of all, we have to calculate interest 2050 after at the end of the year by interest. At the rate of 5%, 10,000 into 5% interest is how much? 500 is the amount of interest. So in by interest, 10,000 into 5%. 10,000 into 5% interest. So 500 is the interest. So here, now to bank account. Final payment again. How much is the installment payment? 10,000 plus interest paid 500. So we are paying 10,500 we are paying. Now on which date? 31st March 2015 we are paying. So how much is the balance left now? No balance is left because after the 3 years the amount has the loan has become zero. The loan is finally paid at the after the first year is here. First payment here. First payment 11,500, 10,000 plus interest. This is the interest calculated here. Interest on 30,000, interest calculated 1,500. So in the 30,000 plus interest calculated 1,500 at the end of the year. 1st April 2012, 30,000 due. First installment is paid on 31st March 2013 by interest 1,500. 30,000 into 5%, 1,500 interest. So here we have to pay now to bank account installment 10,000 plus 1,500. How we got 10,000? 30,000 is the loan. This 30,000 loan is to be paid in 3 equal annual installment. So each annual installment is 10,000. Every year we have to pay 10,000 installment, but we have to pay interest also. Interest is calculated on the remaining balance. First year on 30,000 we have to calculate interest 1,500. So payment is here 10,000 plus interest 11,500 we are paying. So balance sheet is now this credits of 31,500 minus 11,500 to 20,000 due. So this 20,000 is the on 31st March 2013. Okay, now that on 31st April 2013 balance brought down here. Balance brought down 20,000 is the balance brought down here now. So here this is the balance brought down here 20,000. So 20,000 is the balance brought down. So 1st April 2013. So now this after 1 year interest we have to calculate on 31st March 2014 by interest at the rate of 5%. 1,000 is the interest. 20,000 into 5% is 1,000 interest. So here we have to pay now. 31st March 2014 we have to pay 10,000 is the annual installment payment plus interest we are paying 1,000. So total payment is 11,000 on 31st March 2014. So balance credit side total is 21,000 minus 11,000 is 10,000 is the balance CD on 31st March 2014. So this we have to bring down here. This 10,000 is now balanced in the next accounting year. 1st April 2014 balance brought down 10,000. So interest we are at the end of the year 31st March 2015. See that 31st March 2015 we are calculating interest by interest 10,000 into 5% is now 500 is the interest. Okay. So now this we have to pay here in the debit side on which date we are calculating interest. Last date 31st March 2015. On this last date 31st March 2015 we are paying installment 10,000. Every installment is 10,000 yearly installment. Plus we are paying interest also 500 interest. So 10,500 we are paying to bank account 10,000 plus 500 interest 10,500. So now payment is 10,500. So credit side is 10,500. Debit side is also 10,500. That means there is no balance CD. The loan account is closed at the end of the 3rd year because we have already total loan amount is paid. Total loan amount is paid here. So in this way, the loan account is now zero. There is no more loan now. Loan is totally paid. So in this way, this is the preparation of loan account. So first is, see that here in the how we prepare the loan account. First is by balance CD here. Balance CD, okay. Balance CD here. First, this is the loan we got from the partners by preparing the partners capital account. Okay, so this on the date of retirement, 1st April 2012, 11,050 is the first amount paid. This is the part payment of loan. The balance of loan is now 30,000. This loan 1st April 2012. So on 1st April 2012, 30,000 is the balance of loan. So this loan is paid in 3 annual installment. 3 annual installment, but we have to calculate interest also 5%. So how much we are paying? Each annual installment is 30,000 divided by 3. That is 10,000 at the end of every year, we have to pay 10,000, but we have to pay interest also. So how we calculate here interest? On 31st March 2013, at the end of the year, by 31st March 2013, by interest on 30,000, 5% 1,500 interest. Here we are paying 31st March 2013, bank account 10,000 installment plus 1,500, 11,500 we are paying. So balance sheet is 31,500, 31,500 minus 11,500, 20,000 is the balance sheet on 31st March 2013. So this will be brought forward in the next day, next accounting year, 1st April 2013, by balance brought down. This is transferred here. Balance of loan is 20,000 now. 10,000 is paid. On 20,000 by at the end of the year, 31st March 2014 is the end of the year. After 1 year, by interest due is now 1,000 is the interest due. Interest due. Here we have to pay now. Bank 31st March 2014 we are paying now 10,000 annual installment plus interest due. Interest paid 11,000 we are paying. So 21,000 minus 11,000, 10,000 is the balance CD on 31st March 2014. So next day, 1st April 2014 now, by balance brought down 10,000. Right? At the end of the year now, at the end of the year, 31st March 2015, interest calculated on 10,000 unpaid. Due amount outstanding loan is 10,000 now. 10,000 into 5% is 500. So here we are paying to bank account annual installment is 10,000 plus 500, 10,500. See here, now the loan is closed. So how many year? First payment is on 31st March 2013, second payment is 31st March 2014, third payment is 31st March 2015. So in this 3 times 10,000 here, 10,000, 10,000. But first year interest paid is 1,500, second year interest paid is 1,000, third year interest paid is 500. So in this way, we have completed the loan account. In the same way, we have to prepare the loan account in all the questions like this. Okay, so I hope this is clear how to prepare the loan account. So I hope you have understood the preparation of loan account. If any confusion, please ask me. Okay, thank you.